right? Put options actually sound like a very good idea. I'm just thinking that we can't actually do that, but we definitely can build put option strategies. Right, saying inverse ETFs. I've actually worked with inverse ETFs before, and it's worked out quite well for me. Or actually, sorry, inverse ETFs have not worked out very well for me. So I'm actually not a fan of inverse ETFs, right? And it's trying to generate a strategy for me. So I'm going to say, do not generate any strategies. I'm just asking you. I'm going to plan out a strategy here. Okay, so here's what I was saying. Put options are theoretically the most powerful tool for a crash because of convexity. Here's why they're often considered the best for downturns compared to other methods, along with the specific challenges of automating them. Asymmetric risk reward. When you short a stock, your max profit is 100%, but your risk is infinite. With puts, your risk is capped at the premium you paid, but your profit potential can be 500%, 1,000%, or more. As explosive gains on gamma as the market drops, right? The catch for automation, while puts are mathematically the best crash protection, automating them is significantly harder than trading stocks. We can handle any kind of automation. Don't worry about that, about complexity. What would be a good put option trading bot? Please help me plan it out. Do not make it yet. It's really trying not to give me put options, huh? This is pretty interesting. It's saying they're complex. It's actually this, we need to teach this tool about how much power our system has, because we can definitely build that. It's saying, oh yeah, we can't do that because it's complicated to do. Well, that's exactly the reason why we have this platform, so we can make it non-complicated. It actually makes it quite a bit easier to do. All right, let's see. Here's a blueprint for a dynamic put sniper designed specifically to capitalize on multi-week meltdowns. Awesome. The setup, entry trigger. We don't want to buy puts when the market is choppy. Time decay will kill us. We only want to buy when a verified downtrend begins. Interesting. So indicator, 20-day exponential moving average versus 50-day SMA. Signal, when the price closes below the 50-day SMA and the RSI is below 50, confirming bearish momentum. Filter, ideally check that VIX is rising, ensuring premiums are expanding. Interesting. Okay. The contract selection, Greeks. Understand SPY or QQQ. Expiration 30 to 45 days. Why shorter options decay too fast. 30 to 45 days gives you the meat of the move without fighting rapid time decay. This is very interesting. Strike price is saying we want to have a delta of negative 30 or negative 40 out of the money. Why? These are cheaper than at the money puts. If the market crashes, the delta expands towards -1. Okay. In a meltdown, you put your put option will go deep in the money very quickly. The rule, if the option delta hits -70, sell to close and roll down. Buy a new put option that is again out of the money. Okay, stop loss. If the underlying stock closes back above the 20-day EMA, the trend is over. Okay. So what do you think about that? Put it into the comments. Let me know. I respond to all of your comments. So I'm very interested to hear what you thought about the video and what do you want to see next. And of course, if you're interested in any of this stuff, go check it out at botspot.trade.